Indian financial markets took fright on Monday at the humiliating defeat suffered in the pivotal Bihar election by Prime Minister Modi. Dr. Devendra Pant joins me now to discuss. Devendra, pre-election there were concerns a severe loss could put a question mark on the reform process in India. However, others believe markets will chart its own course after a knee-jerk reaction, and this morning Fitch essentially said, do not worry. Now, some sectors haven't been performing as expected, but is it unfair to say it is not a happy Diwali at present?
In past few elections, it has been put to rest until unless whether it's the chief minister or the state or the prime minister, until unless they perform, they are not going to be voted back in power. So we are very sure that the government, despite loss in Bihar, will continue to pursue the reform agenda and put economy in high growth, sustained growth path.
After Friday's NFP figures, probability of a December liftoff is about 70%. But what is the feeling towards how the initial and subsequent moves might impact investment in India? Is there enough pool to keep money in this time around?
The current account deficit is much under control, and the capital inflow has remained very buoyant, whether it's a foreign direct investment or the portfolio investment. Obviously, when how long one will expect an economy or the major number one economy of the world to remain in ICU or on life support. So this is inevitable. The US Fed will start tightening. Chances are now after this non-farm payroll numbers are the 5th December. There will be a knee-jerk reaction or a short-term reaction where you will find some amount of money going out of the country. But at the end of the day, when the reallocation of the portfolios by the foreign institutional investors, etc., will be done in the January, we are pretty sure, because the kind of return which Indian market is offering, the money will continue to flow in, and rupee will depreciate from here, but more or less stabilize after a month or so. That we had seen even post yuan crisis of early August. We had seen the same in mid 2013 when rupee depreciated to a large extent, and then after that it recovered.
Towards the end of the week, we have inflation data and industrial production. But what are you expecting from the reports, and how might the rupee perform as a result?
On inflation front, inflation is expected to inch up, whether we look at wholesale or the retail inflation. Retail on wholesale, there is a deflation. So what we expect the deflation to reduce to minus 3.5% in October 2015. Then September. But the retail inflation is expected to inch up to 4.4 to 4.7% in October from 4.4% in September. Our estimates suggest rupee will average around 65 per dollar in the fiscal year, Indian fiscal year, running from 1st April 2015 to 31st March 2016, which will be roughly around 7% depreciation over where the average was last fiscal.
Devendra, thank you. Well, that's all from Devendra and myself, but it's Monday, so the TV team has plenty more to bring you, including press review, forecasts and the week ahead. So please do keep clicking back to Dukascopy TV. Bye for now.